You're live.
Okay, cool. All right, so I'm Derek Israel. I'm a retired Austin police detective. I'm not like a super tax expert or anything, but I did bring one with me, and this is Walter Ivie. And I know Walter because we're in the same American Legion post together, and when I found on Facebook some conversations where people were expressing frustration and confusion about their taxes, I suggested to him, hey, this would be a good opportunity for us to get out and get in front of a lot of officers, help them with this kind of understand this tax situation a little bit better, and also, get the word out about our organization, the American Legion. So, so what we're going to discuss in this particular thing is we're going to talk about, before I get into that, let me just tell you a little bit about Will. I won't take as long as I did the first time when I went through his entire life story, but Will, I've known him quite a few years. He's been a CPA since right after so I love this story. He was a platoon leader in Vietnam, and he applied to go to the University of Texas, literally kneeling in the mud with a stubby pencil, filled out his application to the University of Texas, and then showed up on registration day having no idea if they ever even got his registration or not, or if he'd been accepted, and stood in line, based on his name, and then when he got up front, he's like, my name's Walter Ivie, and they're like, oh, congratulations, you're a sophomore. So apparently he had taken enough classes while he was in the Army that they gave him credit, and he was actually a sophomore when he went in. He completed a Plan 2 honors program there at UT, and he focused on his interest, which was accounting. He took the CPA exam while he was still an undergraduate, passed it the first time, both unusual things. He went on to get a master's degree in economics. He's taught economics at St. Edward's University and other locations, and he's been a CPA for this entire time. So what we're not trying to do here is he's not trying to find business. He's kind of semi-retired now. He's very involved with the Legion and everything, so he's mainly focused on clients that he's had for decades that he still has. So we're not trying to sell you on anything except the American Legion. There'll be a short commercial for that, but other than that, that's it. So that's who we are. So we're going to talk about how progressive taxation works in the United States, the ways in which different types of income are taxed. The difference between the different types, there's different tax filing statuses, we'll discuss those, and the difference between them. Common IRS forms used for reporting and paying taxes, I'm sure you're super familiar with those, you have to hunt them down all the time, right? And prepayment of taxes, why that's important to a lot of people, especially police officers who work a lot of off-duty overtime because they run into a situation where they have underpaid their taxes and end up getting fined. And then, of course, the big one is all the changes and deductions and this change in the law for tax year 2018, and maybe some strategies a little bit for how to reduce that taxable income. So let me start real quick and talk about the American Legion because that's our sponsor tonight. So the American Legion goes back to World War I. So at the end of World War I, a group of Army officers who had served in France got together in Paris and decided, hey, we've just served in the war to end all wars. There's never going to be a war like this again. No one's ever going to understand the experiences we had. So let's get together, be a voice for veterans, help each other out, and be a group of people that we can trust to talk about the experiences that we had, a mutual support group. Well, as we know, the World War I wasn't actually the war to end all wars. We had a bunch of wars since then. But American Legion started in 1919, and the first American Legion post here in Austin, which is our post 76, was also founded in 1919. So we're celebrating our 100th anniversary this month of being here, part of the Austin community. And since the 1920s, we've owned our post home, which is this beautiful mansion. It's an early settler's house that was built in the 1850s, which at the time was like sort of on the outskirts of Austin, kind of outside of Austin, but now is right downtown, and right there next to Deep Eddy and all of that, right on the right. So, and Legion, this is, we're nonpartisan, not-for-profit, but even though we're not partisan, very political in the sense that it's an advocacy group for veterans. So much like the Austin Police Association, CLEAT, advocates for police officers in the state, American Legion does the same thing at the local level, the state level, and nationally. Because we're chartered by Congress, they have direct access to Congress, and they have direct access to the president. Okay, so end of message. All right, so let's talk about taxes. And the first question is, well, what do you have to report? You know, when you do your taxes at the end of the year, you're actually just reporting what you've earned and your plan for paying all of it, proving to the government that you have paid all of it. So what do you have to report? Well, as it turns out, as an American, you have to report every penny of every bit of income you've earned during that tax year anywhere in the world that you may have earned it. So, and that makes it a bit unusual worldwide because not every government is quite so, has such a great reach. But it doesn't matter where you earn your money in the world, the IRS wants to know about it and will try to take its fair share, or what it thinks is its fair share of what you earn. So, the actual sources of taxable income, and these are the type of things that can cause a taxable event, and that would be your wages from the W-2. That's what most of us get, is most of our income. It comes, on that form that we get in January every year that tells us how much we made for the year, how much they've withheld during the year. So that's sort of the basic income. That's an employer fills that form out and gives it to you. Capital gains, we're going to talk about that in a little bit more detail, but that's simply when you purchase an asset and later on you sell it. The difference between how much you paid for it and how much you sold it is a gain, it's a capital gain, and you owe taxes on that. But it's actually taxed at a slightly different rate than regular income is. Self-employment income, that's the stuff you get on your 1099, alimony or bartering income, right? You trade stuff and you win in the trade. You have to pay taxes on your winning. Canceled or forgiven debt, this is one that gets people sometimes. If someone takes out a large loan from a relative or a friend or something like that, and that person doesn't charge you interest on that loan, or forgives the interest, or forgives any part of that loan, you are required to pay taxes on the forgiven interest and the forgiven loan itself. Gambling, believe it or not, you do have to, there's actually a specific form just to report gambling winning, W2G, right? Yeah. Pension annuity income, if you're like me, you get your stuff, you get paid on a pension, you pay taxes on it just like every other schmuck in the world. Retirement plan income, if you have a 401k, 457D, or any of these weird things that we have, all of that. Sometimes it's deferred, so sometimes when you put it in, like a 401k, when you put it in, you don't pay taxes on it until you take it out. The Roth is just the opposite. You pay taxes on it and put it in there, and then you don't pay taxes on it when you take it out. Much better deal. Social Security benefits under certain circumstances, if you actually are also working and meet a certain income threshold, you have to pay taxes on that. Cashed out vacation or sick time, this becomes a big thing for police officers when you retire. All that cutout check that they call, that's all of your that's all your vacation when you're sick, and that stuff adds up. Let me tell you, it's tens of thousands of dollars, and you owe income tax on all of that. Rental income, that's something that a lot of officers run into because they own second homes and use for rental, and many, many more. These are just a few examples. Basically, just assume that any possible way that you can make money, the IRS wants you to report that you made that money and pay the appropriate tax on it. As Will pointed out in our first session, the number one mistake that taxpayers make, the worst possible thing you can do, is not report all of your income. A lot of other mistakes you can make and you can get past, but if you don't properly report your income, the IRS is going to really cause you problems.
Irritate you.
Yeah, they don't like that at all because that civil, and it's also a crime if you don't report your income. So important, and this is one thing that is one of the most confusing things that people don't understand. This is the most misunderstood thing, I think. I always misunderstood this. But we think, okay, hey, it's tax time, right? Tax time is April 15th. That's when you pay your taxes, right? Wrong. The government says you pay your taxes as you earn the money. If you wait until April 15th to pay your taxes, you're late paying your taxes, and you can be fined for, you pay a penalty, and you have to pay interest on those things. So, IRS expects you to pay taxes as they're earned. This is not a huge problem for the most part with W-2 incomes. You know, sometimes, like you said, you know, if you put in 6 dependents and all of that, then you might under withhold and it might become a problem to you, but usually you can work that out with a W-2. Where it really becomes a problem is if you're getting other types of income, you're getting rental income, you're getting income paid on a 1099. All of a sudden what you find out is that you have not paid enough taxes and then you owe at the end. And this is what makes people upset is not only, and that's what actually started the whole conversation that led to this class, is a young officer was like, man, this really makes me mad. Not only do I owe money, but they're penalizing me for owing money. Yes, you have to pay a penalty.
Let me throw in one comment there. The W-2, I should have said this earlier, the IRS assumes that the withholding that is on your W-2 has been deposited equally during the year. So it's say you come in and increase your withholding later in the year, it still works as if you deposited that month over the entire year. So it's a benefit to you when you're trying to cover your taxes.
So the goal, and that's why we'll discuss it a little bit more later, but that's why people prepay their taxes. So some people are in a situation where they'll run into this problem of owing taxes every year. And this is especially true with people who do a lot of outside overtime, they're getting a lot of that money. They're the ones we talk about, they have to pay quarterly, right? And you can pay, it doesn't have to be quarterly. You can do it all at once. You can estimate your tax, and if you have the money, you can pay it, you know, at the very beginning of the year, or you can spread it out. But the amount that you pay is, if you owe 1 year, you have to take how much you owed that year, you have to divide it by 4, you have to pay it in 4 equal installments or in one lump sum. If you do that, it actually protects you from having to pay penalties. If, say, you did actually under withhold and you do owe, you still owe the money, but you will...
If you pay last year's taxes, then you are protected. If you won the lottery and you made a whole lot more this year, then you're protected from the penalty up to April 15th. The only exception is that if you're well off, they require you to pay 110% of your prior year. If your income is pretty high, you may be required to pay 110% instead of 100%. Actually, 90% is what you have to pay in.
So that's what's called a safe harbor. So it's a safe harbor for you if you do that. If you prepay your taxes based on what you've owed in the past, it creates a safe harbor and it protects you from penalties for anything. So we're just going to work a quick math problem here to show exactly how this works. This is another confusing thing. Some people are confused about the difference between their total income, their taxable income, non-taxable income, all of that. So basically, taxable income is simply your total income minus income that by law is not taxable minus your total deductions. So, so your total income is what you made that year, right? Non-taxable income, there are certain things simply by law you don't have to pay taxes on. For example, disability payments. You don't have to, that's non-taxable, so that would be non-taxable. And then total deductions are all those little things you've done, taxes, local taxes, educational expenses, all these things, these deductions, and that gives you your total, your taxable income. So here's a quick example. This person right here earned $100,000 in income in this particular tax year. 10,000 of it was disability, so that means that takes it down to $90,000 in taxable income, and then they did a really good job of coming up with all sorts of deductions, deducted another $40,000, leaving only $50,000 in taxable income. So that final number, that taxable income, that's the basis that you use to determine how much tax you owe. Okay, marginal tax rates. There's another thing that commonly confuses people. Part of it is that the term marginal has a different meaning, sort of in the vernacular, than it does in the accounting or finance world. So when we talk about marginal, we say, how's John's performance at work? Oh, it's marginal, right? Meaning not that great, maybe substandard. But when we talk about marginal with regards to taxes, we're talking about what your tax rate on the next dollar earned. So that's always the thing to remember, is that your tax rate is based on the tax rate for the next dollar earned. So in other words, not every dollar that you earn is taxed at the same rate. Some of it is taxed at one rate, and some of it is taxed at a different rate, and other parts would be taxed at a third rate. Even if it's all income, and then you add in other ways of earning, such as capital gains, and that's taxed at an even different rate. So we talk about, and we'll get, so like here is a tax, these are the tax rates for a single filer, okay? So just for an example, once you've taken you removed all the non-taxable income, and you've removed all your deductions, so you're that person who has that $50,000 we talked about in that previous slide, the first $9,525 of that taxable income is going to be paid. You're going to owe 10% of that in taxes. So that is the rate for the first $9,525. The very next dollar you earn after that is going to be taxed at the next higher rate, which is 12%. So starting at $9,526, all the way up to $38,700, you're taxed at 12%. And then once you hit $38,700, then the very next dollar gets taxed at the next higher rate at 22%. So the common misperception that people have is that, I'm in the 24% tax bracket, therefore all of the money I earn is taxed at 24%. And I'll show you how that's not the case. So let's look at a hypothetical case here with Ellen. Ellen's single, and she had a gross income of $220,000 because apparently she got a degree in something really good. And after removing all the non-taxable income she might have gotten, minus all of her deductions, she has $175,000 in taxable income. She did not have as good an accountant as the previous example, because obviously we weren't able to deduct nearly as much money. But she got it from $220,000 down to $175,000. So how much will she pay then in income tax? Realizes she only has to pay income tax on that $175,000. Well, the first $9,525, she's going to pay 10% income tax on that. And then starting with the next dollar after that, and then I should say the next $29,175 after that, she's going to pay it at 12%. So that first amount, at $9,525 at 10%, she paid $952.50 in tax on that first amount of money. The second amount of money, that 12%, she paid a total of $3,501. And then the next $43,800 is stuck in the next tax bracket, which is 22%. So for that $43,800, she pays $9,636, which is 22% of that $43,800. And she moves up into the next tax bracket, 24%. So the next $75,000, she pays 24%, and that's $18,000. And finally, she just has a little bit that sticks up into that last 32% tax bracket, So the last $17,500 that she earned would be charged at 32%. So the total amount that she's making is is paying in taxes, I should say, is $37,689.50. So really, compared with the original amount that she started with, the $220,000, she's only paying 17.13%. Of the 175 of actual taxable income, she's paying about 20-something%. So she's not paying 32% on all of that, but she is paying 32% on part of it. Now, this is important for her to understand because maybe she has one of these IRA accounts, right, that had money that was pre-tax that went in, and she's eligible to take the money out without penalty, but she's going to have to pay income tax on it, and she needs to know, well, how much income tax am I going to have to pay on it? If I take $10,000 out of this account, how much am I going to have to pay? Well, the answer is she's going to have to pay 32% on the next $10,000 that she makes as well, because all that money is going to be in the 32% range.
And that's called her marginal tax rate.
And that is her marginal tax rate. So, so it's a wonderful thing. America. Okay, so you may have noticed on your check, income tax is not the only taxes that we pay. We also pay some other taxes that the government says we have to pay. One is Social Security. It's actually a big chunk. It's 12.4% on all wages up to $128,400. And then after $128,400, it drops to zero. So that's marginal as well. And actually the marginal rate goes down after $128,400 to zero. And Medicaid, which is 2.9%, but it's on all your wages. So if you make $1 million, you get paid on all $1 million. The nice thing about this is if you have an employer, you split that money between you and the employer. So your employer pays half of it, half of the Social Security tax, and you pay half of the Social Security tax. The employer pays half the Medicaid tax, you pay half the Medicaid tax. Now, it's more of a problem when you're self-employed and you fill out Schedule C, and then you have to pay all of it. You have to pay the 12.4% Social Security on all your wages because you're also your employer.
We meant to correct that. That should be Medicare taxes, not Medicaid.
Oh, it's Medicare. Okay. So, and then there's federal employment, state unemployment, and those are paid by the employer. So those are all. So the unemployment taxes are 100% taken care of by the employer. They're the responsibility of the employer. The employee pays nothing, and if you're self-employed, you don't have to pay that. Okay, so let's talk about capital gains. The most common situation that you'll find yourself getting into capital gains as police officers, and really as anyone, is you buy or sell a house or other real estate, or you buy or sell negotiable security, like a bond or a stock. So how capital gains works is that it basically is just a tax on how much you make off of an asset. So if you purchase an asset, let's say you buy, we're not talking about our main home here, because for the most part, your home, if it's your homestead, you don't have to pay capital gains on that. So don't worry about your home, you're good there.
Let me hit that real quickly. If you're selling your primary home, which is normally the home you designated with homestead.
This is important. Can you have him talking to the mic? You're loud.
Yeah.
Thanks, Will.
Not loud enough?
Sorry.
Yeah, if you sell your home that you have designated as your homestead exemption, that's your primary home. You not only have the cost you paid for your home, but also any improvements you made to your home that you can deduct off your sales price. In addition to that, you get to deduct $250,000 per owner. Husband and wife can deduct $500,000 of the profit. And so you can see if you paid for your home and made some improvements, plus $500,000, most people nowadays do not need to pay a tax on the sale of the primary home.
So just to be clear, you can hang on to that. So just to be clear, make sure it's clear in my mind as well. So we're not talking about that you own a $500,000 home. talking about you own a $500,000, you buy a $500,000 home, and you sell it for $1 million, that's the $500,000 he's talking about. So for the most part, probably most cops are not going to be in that situation. There's always one, you know, but most of us are not going to be in that situation where we're going to make that much money off of a single purchase. But that's your primary home. There's a lot of cops and other people who own secondary homes. You own a beach house, maybe you just bought a piece of land out in Colorado because you thought you were going to retire there, but you decided you weren't, and you sell it. You might buy individual stocks and individual bonds and sell them later. That's going to cause a capital gain situation. So how you calculate? Okay, so first let me tell you, capital gains are divided into two types: there's short-term and long-term. And really, anytime in accounting you're talking about short-term, you're always talking about a year or less. So short-term is a year or less, and long-term is over a year. So if you're a day trader, you buy a bunch of stocks and you sell them 4 hours later and you make a bunch of money off it, that's a short-term capital gain, and there are ways to mess with this, but we'll just say, in general, that's going to go on your income, okay, because you held it less than a year, so you're just going to pay regular income tax on that. You hold it longer than a year, you're going to pay capital gains. Capital gains are almost always a lower rate than you pay in income taxes. So that's.
Let me clarify that. If you have both short-term and long-term, instead of paying the regular tax on your short-term, you can offset it against the long-term, and then just pay the net long-term gain at the tax rate. But if you wind up with short-term, then you're going to pay your regular income tax on the net short-term rate.
So that's the second time I've heard him say that. I still don't totally understand it, but I do understand that if I was in that situation where I had made a bunch of capital gains, short-term, a mix of short-term and long-term capital gains, I would know that I need to find a CPA to help me make sure that I can pay the minimum amount of taxes possible on that. So that's the difference between short-term and long-term. So in general, you know, they're taxed differently, but there are ways to finesse that, as mentioned. So here's the other thing, could be a little bit confusing. Capital gains, you only owe capital gains once they're realized, which means if you buy a second house, and let's say, you know, it's in Austin, you bought it at $200,000 and it's worth $500,000 now, that's $300,000, but that's unrealized gain until you sell it. The day you sell it, it's realized gain, you owe that money. That could be important. I mean, that's more important from a business finance standpoint because they keep track of unrealized gains like that. But, you know, it can be important to understand as well that your potential liability in terms of capital gains, they're always there whenever you think you might sell something. And where that liability is most likely to come up, or, you know, unexpectedly, would be if you die and all of your assets go to an heir, and then the government is going to realize all your gains at that point, and they're going to tax you.
They're not going to tax it actually. The biggest tax break in the whole tax system, we didn't mention this morning. If you have property and you depreciate the property as a rental property, and it goes to where you've written the whole property off, you have no basis left in the property. At that point in time, at your passing away, you're allowed to mark up the property back to market value. That's supposed to make you pay a lot of state taxes, but due to the 10 million, a pretty high number now for state taxes, you probably won't pay the state taxes, but you do still get the markup to the market value on the property.
So it gets a new cost basis.
Without tax. Your new basis becomes your market value when you pass away.
So use the word, we'll define it here, cost basis. Cost basis is what you paid for the asset in the first place. So how you figure out how much a capital gain is you simply subtract how much you sell it from, or sorry, you subtract the cost basis from how much you sold it from. It's a positive number, and then you made a realized capital gain, and you need to, it's a tax liability. So, but as Will kind of mentioned here a little bit, and he went into more detail earlier at the earlier session, this doesn't really work on stocks and bonds, but if you own a house, for example, you have a second house, you paid $150,000 for it, and then you put an addition on for $50,000. So now you just changed the cost basis to $200,000. So you can increase the cost basis by improving the asset, which reduces the amount of capital gains that you have. And when you do sell an asset like that, the IRS, you have to report to the IRS the cost basis along with the sales price. And I guess at that point you would also add in whatever improvements you made, right?
Yeah.
Adjustments.
The improvements would be part of your adjusted cost basis.
So, any questions on that? Any questions on capital gains? That one, I think it's fairly straightforward. It's good. Capital gains are good because they're taxed at a lower rate. And we're at the very end, we talk about the new rates. We're going to talk about that. And actually, capital gains are much even better now than they were before. So let's talk about the different types of tax forms that you commonly run into. W-4. This is a tax form you prepare as an employee at the request of your employer. You use this form to report your Social Security number and your taxpayer ID number and your withholding preferences. And that's where you get to put in 6 and single, right? So that determines how much withholdings are taken off during that time period, during that tax year. You generally only fill that out once, but you can change that at any point during the year. W-2, that's prepared by, if you're an employee, your employer is required to prepare this for you and provide it to you by the end of, I think, January, right? And that reports all your wages, tips, all that stuff, plus all the withholdings they've made. And that basically is your key form for preparing your income taxes and proving what you made and what you owe. And then there's Form 1099 that reports income to non-employees. So if you hire someone to do some work for you and you pay them more than, how much? $600, you have to provide them with a 1099. And that's just one of those things that, so the IRS can keep track. Because when an employer or a contract, a person who's paying somebody for contract labor prepares a W-2 or 1099, they provide it to you and they provide it to the IRS. So the IRS knows theoretically what you made throughout the year, so they can make sure that you report it at the end of the year. Then there's the 1040, that's the big one, which is individual tax return. Since you do them by hand, if you don't be looking for a 1040A anymore, or 1040 Easy, those are gone. It's just the 1040, and but there's a bunch of schedules on it.
Yeah, they due to the congressman lobbying and saying that they were going to make a postcard tax return. They made it look like a postcard, but in order to make it work, they had to add a bunch of schedules that are also postcards.
Yeah. So that's politics. That's when politics and taxes intersect, which is common. Then your Schedule C, which is how you report your profit and loss from the business. And we'll talk about this when we talk about the differences, but that becomes key now because now on that Schedule C, that's really the only way you have left to take deductions, business-related deductions is on that Schedule C. You can't do that on your 1040 like you could in the past, or on there's a form for it. Yeah, the itemized. And then there's the dreaded Form 2210, which also was what started this whole conversation because a guy posted on Facebook, what the hell is a Form 2210 and why do I have to fill it out? And why do I have to pay it? And so that's when you underpay your taxes and now the IRS is saying, congratulations, This is the form you fill out to tell us how much you're going to write the check for.
Calculate your penalty.
Yeah.
The 2210 is also the form that gives you the exemptions from the penalty, so you can select why you don't need to be paying the penalty and report it on that 2210.
And here's another thing too, and I didn't mention this in the first one, and I think it's very important to mention. If you find yourself in an unexpected situation where suddenly you owe a bunch of money to the IRS, and you don't happen to have a bunch of money to mail that check to the IRS, and this is not an uncommon problem at all. So let's say, theoretically, you're me and you're preparing your form on April 15th, right, to mail in, and you realize, oh crap, I owe $5,000 and I have $11 in my bank account. There's no way I can send this off by April 15th. Don't panic too much, and also bear in mind you may owe penalties and interest on that as well because you underpaid. Call the IRS. You can call, and during the tax season, they're fully staffed. They'll answer your call, and you can request an extension. I think a lot of people know this, some people don't. You can get an automatic extension to October to pay off your the money you owe.
The extension is a filing extension. It is not a payment extension. However, I believe there's a form that's still in use that you can fill out and get an automatic payment over, I think it's 12 months, 12 payments or something like that.
Well, I can tell you, I can only tell you from my experience because I ran into this exact situation. And I called them and I said, hey, listen, I noticed, I owe you guys like $5,000. Is there a way I can get, so they asked a bunch of questions. Why did this happen? And research this a little bit. It turns out they have like some sort of computer program they enter all your answers in that tells them whether or not they can waive your fees and your penalties. And in that case, my story was sad enough that, and also, the big thing was they wanted to hear, how do I know that you're not going to do it next year, the same thing? And I explained the situation. It was actually, my W-4 was filled out incorrectly. I had too many, not enough withholdings, and or too many, whatever it was. And
you can request a waiver of any penalty. Any penalty can be requested for waiver. They won't necessarily always grant that. In particular, if you requested a waiver of penalty in the past, that makes it highly unlikely they will waive your penalty in the future.
Mm-hmm. And I didn't have to pay it until October. I might have paid it like monthly or whatever. I think maybe I did, but I didn't have to write them a check for $5,000 right on the spot. I didn't have to pay penalties. So my thing is, if you run into that situation, call them, explain the situation, and see what they can do for you. Try not to do that every year, as I pointed out, because they're probably not going to help you out more than once, but you are allowed to do that. So, okay, this is going to be, Will's going to talk about this. This is the changes for 2018.
Okay. Here's what happened on the new Tax Act. It used to be, prior to the new Tax Act, you had a standard deduction, and you itemized taxes, and you had a personal exemption. And so if you're a husband and wife with no children, then you had two exemptions, and that was about $7,500, I think. It's now about $8,000 for two people. And you add to that the married filing jointly standard deduction, which was $12,000, and you had about $20,000 that you could take off for that. So the married filing, new one for the married filing jointly is $24,000, whereas combined exemptions for two people and standard deduction was about $20,000. You now get no exemption, but you get $24,000 as a standard deduction without doing any cost analysis. Single was about $7,500 or $8,000, I think, and is now $12,000. And head of household was also gone up from about $10,000, I think it was, to about $18,000. And you do get additional amount if you're over 65 or if you're legally blind, and each person gets that additional amount. So if you have a married filing jointly with one person over 65, you get $1,300. If you have a married filing jointly with two people over 65, you get $2,600. So your total for two people over 65, married filing jointly, would be $26,600. Okay?
So getting old isn't as bad as it seems.
And if they happen to be legally blind, they get another $2,600 if there's two of them that are legally blind, or $1,300 if there's one of them legally blind. Single individuals on this extra exemption get $1,600. So if you're single and you're over 65, you get $1,600 extra, would be $13,600. And if you were legally blind, and again, you get another $1,600.
And so let me just clarify, because I think there were a lot of kind of questions about this at the earlier one, so I kind of know how people are thinking. So you can either itemize, or you can take the standard deduction. Okay?
Right.
So if you use TurboTax or something like that, usually it'll have you itemize, and then at the end it'll say either, oh yeah, itemizing worked better for you, or just take the standard deduction. You can also just figure it out yourself using the worksheet, the itemizing worksheet, to figure out how much you owe. But the $24,000 is actually quite a bit. So
Yeah, so there's gonna be a whole lot of people that will be doing standard deduction now that used to do itemized. There's more reason for that we're about to tell you about.
yeah, my personal situation, I was always just barely over the standard deduction. So now I should be well within the standard deduction. So I'm looking forward to that.
All right, personal exemption eliminated. This is, however, you know, we talked about married filing jointly getting the $24,000 standard deduction. We said, what if they have kids though? Well, there's no exemptions for the kids anymore. They don't get the $3,500 to $4,000. But there's something better. Now, instead of a $1,000 child tax credit, it is $2,000 child tax credit. And I need to make you understand what a credit is, because a $2,000 tax deduction is worth 1/5, we'll say, of a $2,000 tax credit. A tax credit is a credit that comes right off of your taxes. After you've gone through all your deductions, you calculated your tax, then your credits are just subtracted from your taxes. So $2,000 tax credit per child is a pretty substantial amount of money.
Yeah, that's huge. It comes right off your bottom line. If you owed $5,000, if you did all your stuff, you figured out you owed $5,000, now you only owe $3,000.
Now, we did find a hiccup here. Dependent age is and was up to anyone up to age 9, until they turn 19. They can be a child, can be your dependent. And then if they went to college, they could continue to be your dependent until they were 24 years old. The child tax credit, however, they snuck one in on us. That cuts off as soon as they turn 17. You no longer get the child tax credit. However, you may get a new one, which is called the dependent credit. And that's for any dependent. If your child is over 17 or over, then they may qualify for this $500, again, credit, not a deduction, for each child. So that $500, depending upon your tax rate that you're paying, is probably equivalent to that exemption amount that you used to get. But here's another change that's going to make you want to take the standard deduction instead of itemizing. State and local income taxes are now limited to $10,000 for everybody. So most you can deduct is $10,000. If you file you're married and you're filing two separate tax returns each, that $10,000 limit is $5,000. Okay.
So that $10,000 is married filing.
No, everybody gets $10,000, but if you're married filing separately, you share that each can do $5,000. The uninsured penalties under Obamacare, are still in place for 2018, but they eliminated the penalties effective for years after 2018. So you still have to get the forms and report it on your tax return, but there's no penalty after 2018 filing for not having been insured.
And just a quick question, I just want to make sure everyone understands the difference between a deduction and a credit. Does everyone get that? So that was new to me, right? Deduction reduces your taxable income. So whatever tax rate you're in, whatever marginal rate you're in a 10% tax rate, you know, $1,000 reduction in your taxable income that's $100, you say. Whereas a credit comes off the bottom line. So $1,000 tax credit is really equivalent to like a 10% interest rate to like a $10,000 deduction. So it's huge.
Okay, and here's another biggie that is going to affect everybody that tries to itemize, particularly the wealthy people. After 12/15 of 2017, if you got a new mortgage, you can only deduct interest on up to $750,000. That's all the interest you get to deduct. It's limited. Also, interest on home equity loans is not allowed to be deducted, although we'll have some arguments with the IRS on that because people have used the home equity loan to borrow money against their home in order to start a business. And I think in those circumstances, there may be some questions for the IRS with regard to that.
So that would be a kind of a narrow thing where somebody is self-employed, has their own business, and they're taking off a Schedule C or something.
Yeah, and the home equity loans for a while were cheaper than other loans, and so some people borrowed against their home equity.
But in general, if you have a home equity now, it's no longer deductible.
Yep. Moving expenses are not allowed during this 2018 to 2025. That's the time period that they covered the moving expenses on the Act, and during that time period, they're not allowed to be deducted. And employee business expenses, that's formerly the Form 2106, no longer can be deducted, and the next thing will tell you why. Okay, all miscellaneous itemized deductions that were subject to 2% threshold, you had to have 2% of your net income, of your taxable your gross income, had to be incurred before you got $1 of deduction. That's what we call the 2% cap. All of those deductions have been eliminated. But there are other deductions that are miscellaneous itemized deductions, and those that are not subject to the 2% floor, and those have not been eliminated. One of the biggest being gambling. And so if you report gambling income and your gross income and your taxable income, then you still can deduct the gambling income as a miscellaneous, gambling losses as a miscellaneous itemized deduction. Of course, once you take that deduction, then you're not going to be able to take the standard deduction. Good.
So, and just to clarify on this, because another confusing thing, he's not saying that the 2% AGI threshold went away. He's saying that anything that had that threshold, any deduction that had that threshold, is no longer a deduction. You could no longer deduct that expense.
And again, next line, anything that did not have that 2% floor, in other words, you got to deduct every bit of it as a miscellaneous itemized deduction, those are still allowed. Another area they cut back, casualty and theft losses are limited to areas where a natural disaster is declared. So if there's no natural disaster, there's no casualty or theft loss. Okay, here we just want to show you the capital gains rates, when you might be impacted by them and what the rate might be. Because you might want to decide to sell your vacation home or something, and you want to know what tax you're going to pay. Well, here's the threshold. I didn't put up the 0% rate because these numbers here are the end of the 0% rate. There is a 0% rate. For example, on the married filing jointly over here, $77,200. If your income is below, taxable income below $77,200, that includes the gain though, right? If it's below that, you actually pay 0% capital gains rate. It's amazing. Some people get capital gains and don't pay any tax.
Can I ask a question about that? Is that marginal, or is it like, if once you hit that threshold, you have to pay on all of it?
Once you've gone over the $77,200, then you go into the next tax rate.
Okay, so the first $77,200 is not taxed at all, and then.
No, it is taxed.
Oh, it is taxed. So once you cross that threshold,
Then
it goes
you-
back to zero, and you start paying that tax.
You go back up to the next
Got it.
level. Yeah, so, the 15% rate on the married filing jointly, you exceed the $77,200, you pay 15% on your gain, your entire gain, okay? Up to the 20% rate, which is the next line. If your income can go, say your income has gone above this number here, this is the threshold amount for the 20% rate. So if your income goes up to $479,000, then you will be paying from that point, you will be in the 20% capital gain rate, okay? And you will pay 20%
On all tax, yeah.
Yes. Okay, these are the tax tables, and first off, let me tell you that the rates have decreased. The lowest rate used to be 15%, is now 10%. No, I'm sorry, 10% was still there. 15% is now 12%. 28% is now 22%. I'm sorry, 25 is 22. 28 is now 24. 33.6 is now 32, etc. And actually, they added some rates, 35 and 37 for higher income. But we've got the high, for example, married filing jointly here. If you make less than $157,500, you're going to be paying 24% on your marginal rate. Again, this is important you understand marginal rate. $157,500, your next dollar will go to 32% instead from 24%.
And what this doesn't show also is that you have that standard deduction, like say you're married filed jointly, it's $24,000. That first $24,000 is zero. So that's zero.
Yeah,
And then the first dollar after that $24,000 or whatever, if your deductions are above
These
that.
threshold amounts are in fact your taxable income. So if you have that 24,000, 26,000 whatever deduction, this is what's left over. And if it adds up to 157,500 for married filing jointly, no, 315,000 for married filing jointly. Yeah, if it adds up to 315,000, then you go to that 32% rate. If it adds up to something less than 165,000, you're at that 22% rate. So it's pretty high. It gets to be pretty high numbers. You're probably going to be in that 22%, 24% range for most people nowadays. Okay. We'd already talked about this, and I'm sure most of you, if you've done it before, are familiar with it. But if you get 1099s, you get to take the Schedule C, and that's just where you report your gross income from the 1099s. And but then you're allowed to take your deductions. If you used to be able to take them on the itemized deductions as an employee business expense, now the only place you're going to get to take them is on that Schedule C. If you have a rental house that you own and operate, rent, that will be on Schedule E still. And again, you have the gross income and any expenses related to that can be deducted on that Schedule E. And then you'll pay, that gets added into your taxable income, and you'll pay these tax rates on it. As regard to police officers, uniform expense, may have taken it as an employee business expense. Now you may want to deduct it, or any other items like that, on your Schedule C, along with your 1099 items. As we said earlier, some people want to fudge a little bit and get as much as they can on deductions. The main thing you want to know about the IRS is report every dollar of income. They may get suspect on your deductions and question your deductions, but they don't get mad at you. They just say, you took a little bit too much there, we're gonna allow this instead of that. If you don't report your income, they get real mad. So go ahead and report all your income, and then if you need to wonder about, well, did I really do a few extra miles than what I thought I did or something? More than the IRS might think I did, but you might take a few more miles in your mileage or something. You might fudge the numbers of deductions a little bit, but don't mess with income.
Did you want to talk about that? I can't remember what it's called now, but that.
Oh,
20%,
yes, I forgot, 199A. That's another big thing that happened this year. It's section 199A, and that's the name they have for it. That's what they call it, 199A income. They dropped the corporate income tax rate down, I believe, to 25%. Most of my clients don't pay corporate. Nobody pays corporate rate. But anyway, they did drop it. If you're a big business, you have to pay the corporate tax rate. And it went down, I think, 25%. And they felt guilty about individuals that operated business. And so they gave us another deduction to kind of compensate for that. We've already got the lowered tax rates, but in addition to that, if your income is classified as qualified business income, and for the most part, the only thing they've stated as to what is qualified business income and what is not is CPAs don't have qualified business income. I think they might have included lawyers. But other people, they say if you make your income in this business because of your reputation, movie stars, for example, might fall under this, then you're not qualified income. So CPAs and lawyers are included as being not qualified. Everybody else, you've got whoever's preparing the tax return has to ask themselves that question. Is this qualified business income? And so you answer on the tax return whether you think it's qualified business income or not. And as a result, if it is qualified business income, you get another deduction on your 1040, not on your Schedule C or Schedule E. It comes up on your 1040, and it's equal to 20% of your net income on your Schedule C. So that's just a big whop off the top on your taxable income. So you have a Schedule C, and then you have $10,000 worth of net income on that Schedule C. You only have to pay tax on $8,000 to another deduction.
So, and that pretty much affects anybody who is doing a Schedule C, right? Which is going to be a lot of police officers.
Also rental income, Schedule E. If you own a house and you rent it out, that counts there also.
And that's huge. And there is no upper limit on that. You can make $1 million and you still get the 20%.
Yeah.
Doesn't matter. No minimum, no maximum.
And finally, I'll say that used to be we had a lot of things phased out, like on your itemized deductions they would phase out. I believe they eliminated the phase out on all that stuff. So
the phase out due to income threshold?
Due to income. That's not the case on education expenses. They still have a phase out on those, but on itemized deductions, there's no longer a phase out, I believe. However, very few people are going to be doing itemized deductions unless they do have high income, because you've got the tax credits for your child and you've got the high standard deduction.
And that phase out thing is big too, because I can tell you, when I retired, the department writes you a huge cutout check, right? They pay all your accumulated sick leave, they paid all of mine. There's certain numbers for it. I guess it's lower now because of contract, but it's still going to be a ton of money, especially that sick leave money. And so when I took my cutout check plus all that money that I earned that year as well, just for my retirement, I became and plus my wife works, right? So all of a sudden I got pushed into this category of wealthy, right? Which we all know isn't wealthy, but by wealthy, they meant that I lost a crap load of deductions and type of things that were phased out because I hit some income threshold and can no longer do it. So getting rid of those income thresholds is nice because, you know, there's going to be maybe that 1 year where you take home this a huge amount of money, and that had a huge effect. That's not marginal. You know, we talk about marginal, the cost. That's like, you know, that's a huge marginal hit on your thing, because the next dollar, once you get over that threshold, goes back and puts taxes back on, you know, a bunch of money below it. So, you know, it gets real expensive. It would get real expensive.
It's usually ratably increasing from a range of income. Any questions that we can ask that you had on your tax return, or what you be glad to answer? Good.
Can you remind me where like union dues fall in the miscellaneous deductions? Were they on the 2%?
Union dues?
Union dues. They fall on the 2%?
I think they came under that miscellaneous itemized deduction, which is probably eliminated.
Okay.
So, and again, you're not going to do itemized anymore, so probably it's gone.
Okay.
But you get lower rates, bigger
Right.
standard deductions.
Where were you making the most money on your itemized stuff?
Work expenses
Work
and
expenses.
charitable giving.
Yeah. Again, if you have other 1099 income, you can take some of those expenses on your Schedule C.
If you do take it on the Schedule C, do those expenses have to be directly related to that work?
Yeah. That's a judgment call. Remember I said you're going to fudge some numbers? That's where the judgment call comes in. Is do I take my cell phone? Was that necessary for me to go do extra work? Stuff like that.
How about your, you pay for legal coverage?
For legal?
Yep, legal coverage to cover you for
Yeah.
where you're at for.
Yeah, that could be on your Schedule C.
Okay.
Yep. If it was covering you on the job and your overtime, then you may want to prorate it. That's where the judgment comes in.
Oh, because if it's a combination of
Yeah.
both.
Yeah. So, but there's, you know, mileage. If you are an employee, when you drive to the headquarters, that's called commuting. But once you're at the headquarters, if you have to go out and drive your own personal vehicle for some reason or other, then that's not commuting, that's deductible mileage. It was deducted on the employee business expense, no longer can be deducted there. But if you have mileage with regard to your overtime work on Schedule C, then you can deduct some mileage at 54 cents a mile on your Schedule C.
So mileage from home to and overtime?
Yeah, because there's not a place of business. As an individual, self-employed individual, your office is your home.
Okay.
And so any mileage from there would be deductible as a traveling expense.
That's an example. That would be like a home builder. I work for a home builder, security. I traveled all their sites all over the city. I deducted all those miles.
Yeah.
So I said that for the camera because I know some people still have that job.
Yep. And you're going to want to keep track of your beginning of the year mileage and end of the year mileage. That's some of the reporting you do when you deduct that mileage.
Yeah, can you talk for a second? I mean, that's how you bring up a good thing. Tell me, I mean, obviously you get tax forms that are sent, but if you're going to itemize and there's questions by the IRS, what forms does an officer need to make sure that he or she keeps so that they can prove their stuff?
Yeah, all of your forms like your 1099s, W-2s, interest paid, if you do have a rental properties other than itemized deductions, if you have interest on your business, maybe you had a loan with regard to the business that you're doing, you might have interest there. But anything you get reporting your income or your expenses from a bank or employer or payor, you should keep those. And then any computations that you made to justify the deductions you made, hang on to those.
So let's say you're deducting all this mileage. You're doing a lot of driving for your job. A log of your mileage, is that the best way to do it?
Yeah, actually there's this is a good thing to know, there's various ways that you can document mileage. easiest way that IRS will definitely accept is you put down your odometer at the beginning of your trip and odometer at the end of the trip every time you drive. That's kind of troublesome. You do not actually have to, it's called contemporaneous documentation. You don't actually have to do that. You can go back after the fact and do that later. And as long as your best estimate, they accept that at the IRS. One other way to do it is to take a period of time during the year and go ahead and keep the records, and then use those years to kind of estimate what your mileage was probably the rest of the time.
So how long should people keep their tax records?
The IRS can go back 3 years after you file, unless they think there's fraud involved, which again, report all your income. Then they can go back, I think 7 years or longer.
Yeah. Speaking of fraud, avoid it. Avoid all of the little scams that people tell you about, you know, if you do this little magical formula, it's gonna, you won't owe taxes, right? You always owe taxes. You always have to report all of your income. You always have to pay it. You know, Millard Fillmore didn't accidentally forget to sign some document that made the, you know, tax code illegal, okay? If people are telling you that, don't do it. That will end you up in prison. Don't do that. So there's certain things that are mistakes that'll get you little penalties, get you little fines. Things like lying about your income, intentionally misreporting things about your income, you know, can result in criminal stuff, which you don't want to have to mess with. And I'll tell you, here's the thing too. You go to a tax preparer and the tax preparer says, I guarantee I can get you this refund if you bring your tax return to me. You are committing a federal crime, and you could be in a lot of trouble for that. It's not super common in Austin, but it is very common in other cities. I'm saying this because I know a lot of these people, a lot of these young officers are, you know, they don't know, you know, and they can get into really weird situations. And I've seen that personally. That there's even a name for it. It's called boosting, where they come in and they artificially inflate your thing. All those things, super common, happens a lot. Even if you don't go to prison for it, you're gonna get hit with huge fines. You're gonna owe a bunch of money. And if you owe money to the IRS, they have no problem getting it. You open a bank account with your Social Security number, guess what they're gonna do? They're gonna take all that money out of your bank account.
Yeah. Let me just add this. Whenever you're trying to decide how much you would deduct as an expense on, say, your Schedule C, most people are afraid of the IRS, and so most people underestimate how much cost could be allocated for something. One of the things you get by going to CPA is they are more knowledgeable about what is a reasonable deduction and what is not. But when it's your judgment, you make that deduction based on what you think is the real number.
Thank you.
Excellent. Thank you.
All right, I guess we're good.